Does it feel time and time again like you are being watched and your stops are being hunted? Then you are not alone. This is a common complaint of many retail traders. The problem is that you are probably entering at the wrong times in the market. Today we'll fix this, and I'll share a very simple scalping and day trading strategy to trade any market. The concept of this strategy is derived from the two major phases of price movement, expansion and contraction. So, like, subscribe, and stick around for the full video. Markets go through periods of contraction when prices move in a narrow range, while traders' interest comes down. These periods of narrow range are called contraction. When markets are doing nothing, they are giving a message: we have a balance between bulls and bears. Neither is strong enough to take the market in their direction. Soon enough, one of these forces, either the bulls or the bears, will emerge as the stronger force. Then comes a period of expansion, when the winning force will take the market sharply in its favor, trapping the losing force. This is the period when the markets will move outside the previous ranges in one direction. Identifying the waves of contraction and expansion is a powerful skill to have, and one of the simplest ways to find these periods is by analyzing inside bars. Inside bars on a candlestick chart represent the consolidation of price action, where the bulls and bears are both struggling to move the price higher or lower from its current position. You can easily spot an inside bar when a given bar's high and low are fully contained by the bar directly preceding it. This signals a narrowing of price action, a contraction that can be used to anticipate upcoming movements outside of this range. Basically, when there is contraction, pressure is building. On their own, inside bars can be quite tricky, especially if you are unexperienced. You can find hundreds of inside bars during a trading day if you trade lower timeframes. A double inside bar setup will solve this problem and will highlight the period of contraction even better. A double inside bar is when there are two consecutive inside bars which have failed to breach the high and low of the previous bar. It reflects contraction and indecision. This price action setup, although rare, is more significant than just an inside bar. The colors of the bars are irrelevant. The fact that we have two consecutive bars inside the previous bar range is the main aspect here. Double inside bars are a rare contraction signal, so rare it would be a shame to miss the opportunity. You can trade both trend continuations and key reversals. If this setup is present at the key technical level, maybe a major support at a round number or a fib level, or at a pivot level, or near a moving average, it can often reflect a change in sentiment and a great opportunity for you to take advantage of. We'll cover many scenarios later in the video. If there is no technical level in the way, then the safest way is to trade the setup as a continuation one with the prevailing trend. Let's simplify the process of searching and analyzing candlesticks, and let's use an indicator which displays inside bars. I use this one. It finds and reveals all inside bars on the chart. Your job is to simply find the double inside bar setup when you see two consecutive arrows. Here's the trading plan. In a trending market, you will trade only with a trend by trading continuation breakouts. In a range-bound market, you will sell the top of the range and buy the bottom. In both cases, the location of the double inside bar is very important. My preferred locations to trade are near levels of support and resistance, trend lines, moving averages, Fibonacci levels, daily pivots, and round numbers. We trade Bitcoin on the 5 minutes time frame. We see a clear downtrend, with price making lower lows and lower highs. And now we are in a range. In this case, I would prefer short trades in the direction of the dominant trend. Here's our double inside bar setup. As we are near the resistance level of the range, the plan is to short a breakout to the downside. Price broke the upper level of the channel, but we ignored the signal. Remember, you don't want to fight the existing trend. Next candle brought a downside breakout, so we entered short. Stop loss goes on the other side of the channel. We're above the previous swing high. It all depends on the size of the channel and recent price action. As for take profits, as I'm trading the 5 minutes chart and I'm scalping, I target the next swing in the price structure, at least. In this case, this swing. Then you can use a trailing stop, a break-even stop, or whatever money management technique you prefer. But your trade should offer a positive risk-to-reward ratio. Now we see another double inside bar below the first signal. As we are already in a trade, we ignore this one. Let's find another trade. Price again seemed to form another range, again in a downtrend. So we'll keep looking to sell the market. Here's our signal, 2 consecutive inside bars. If we zoom out, we see that the signal appeared below this breakout. This seems like a break and retest situation, and the location of the double inside bar favors a short trade. Here's our breakout. Stop loss on the other side of the channel. We're above this swing high. As we are already very near the previous swing low, we expect price to break it and to continue the downtrend. Let's try a risk-to-reward ratio of 3, but we'll keep an eye on the price action. Another good trade, and we even left some profits on the table. Again, you can play with the take profit and try different techniques. Let's continue. Here's our signal. We have a double bottom here and a small break of structure. But at the same time, the setup appeared at this swing high in a downtrend. So the situation isn't so clear. I still favor the short trade, but if the breakout occurs to the upside, I'll still risk a long trade. Okay, we have a downward breakout, so a short trade it is. Stop loss above this swing high, above the channel. Take profit at this swing low, a few points above it. Let's change the market. Let's trade a pound dollar, and let's add a moving average. If price is above the 200 EMA, you'll trade only long breakouts above the double inside bar setup. If price is below the 200 EMA, you'll trade only short breakouts below the double inside bar pattern. In this example, price is below the 200 EMA, so in this case, we'll target short positions. Here's the signal. We have consecutive inside bars around this resistance area. We have a triple rejection in a small amount of time. As price broke the channel to the downside, we entered short with a stop loss above the channel and a take profit around the swing low. That's a risk to reward ratio of 2. We move on. Price broke above the 200 EMA, so now we are looking to buy the market. And here's the signal to enter. Consecutive inside bars. You buy here at the breakout of the channel. Stop loss below the channel. Take profit at the next swing high. That's a risk to reward ratio of 4. We lost the trade, despite the fact it was actually a pretty good signal. Let's once again change the market and trade Tesla. I see a downtrend, lower lows, lower highs. And here's the double inside bar pattern. I favor short trades, but if price breaks to the upside, I'll still take a long trade. The pressure remained to the downside, so we had a downward breakout, in line with the previous trend. Stop loss goes above this swing high, and we target the previous swing low. Another signal after we close the previous trade with a profit. The location of the pattern below the previous swing low favors another short trade, which indeed happened as price broke once again the previous low. Stop loss above the channel, and as we don't have an immediate swing low to target, we set a risk to reward ratio of 2. The beauty of double inside bars is that they can be traded as both continuations and key reversals, and it's all price action based. By scanning the market for trends that are in place, you can start to identify periods of price contraction, where a trend has stopped making higher highs and higher lows in a bullish trend, and lower lows and lower highs in a bearish trend. When price breaks from these contracted areas, it reveals that either the buyers or sellers have regained control of the trend and can help you time your entry and ride the momentum. This is not a perfect strategy. You will encounter losing trades, and for this reason, you can put your own spin on it, additional confirmations or other types of analysis. If you can back up consecutive inside bars with other technical tools, it might be worth opening a position. Just make sure you don't overcomplicate it and stick to the main concepts of this strategy, finding periods of contraction and ride the momentum move after the breakout. As always, if you learned something new and found value, leave us a like to show your support. And check out our Academy program if you want to further level up your trading. Until next time.